It's Brian Preston, the Money Guy.
If we think about trading days in the market over the last 70 years, just thinking about as measured by the S&P 500, 46% of individual trading days have been negative. So that's almost half the time. So some days the market's up and some days the market's down. And if you look over the last 70 years, the S&P 500 has dropped by 20%, has gone into bear market territory 11 different times over that period. So right now you're saying, oh man, I just don't know. The market, half the time it's going down, and then the other parts of the time it can lose a lot of money. It is frightening. What should I do?
Well, there's several things, just off the cuff feedback. When I saw that stat of 46%, I was like, man, that's almost a coin flip. Mm-hmm. But then how does that compete with, and then I started thinking about something we share on the show all the time. In a decade, meaning 10 years, pretty much 80% of the time, markets are good. Mm-hmm. So if day by day it's a coin flip, but I know on a decade, if you look at it from a year standpoint, 8 out of 10 is pretty good. And then I hear the stat that we've only had 20% downturns. Was it 7 times?
11 times.
11 times. 7-11. I guess that's where I was getting it. But 11 times, it starts to show me there's something that's leading me to believe that time has some component in this analysis.
So let's talk about that a little bit. We wanted to share a few quick illustrations with you. The first is one that we have developed here internally. If you look at just a 60-40 portfolio, and when we say 60-40, that's 60% stock, 40% bond portfolio, from 1953 all the way till the end of 2021, and you look at individual year performance, it seems sort of haphazard. There's no rhyme or reason. There's no pattern. It looks a little sporadic, but on average, we know that the average return over that time period is an average return of 9.8%.
I think it's wild because I see the green line there, the 9.81%. And this is 53 to 2021. But you're right, Bo. Just looking at the visual, for those who are listening to this on the podcast, it looks all over the place. Each year is a dot, essentially, on annual performance, and it looks like no rhyme or reason on this scatter plot. Mm-hmm.
However, if we don't just look at it in isolation, if we don't look at it on a year-by-year basis, but we stretch out our timeline and we say, okay, let's look at returns on 10-year rolling periods, exact same years, exact same portfolio, exact same time period, what you can see now is when you stretch out your time frame, there looks to be a lot more order to it. It looks to be a lot more reasoned. It almost looks like it's cyclical. And now everything kind of compresses towards that average. That 9% annualized decade performance on here is pretty close. And you see, there aren't any decades on here where a 60-40 would have lost money. So that's interesting. When we think about the market, we have to prevent ourselves from focusing on the 46% of days that are down and think more in terms of the long term.
Well, I find it interesting looking at the visual of this, but also making sure I'm doing a good job of describing it for all those who are listening on the podcast. You've already nailed the fact that there's not a single one of these decades that's zero, because this is a diversified portfolio. Right. It's not just 100. We've heard of the lost decade, but that was 100% equity portfolio. And I also find it amazing the ebb and flow of getting close to the average, meaning that it gets close and then it goes apart, gets close. I mean, it really does look almost like a sound wave that's everything, that's got a magnet that attaches it to that average return. This is pretty powerful stuff. So that's very important. Missing the mark, time is incredibly important in this illustration.
Let's talk about, we said that, there's been 11 different time periods where the market has lost 20%. What about those? How do we think about those in perspective? Or there's a great illustration we hear that we want to show here that just compares from 1942 all the way through this year, bear markets versus bull markets. And there's really two things that we're looking at here. For each of the bull markets, how long did they last in terms of months or years? And for the bear markets, how long did they last? And then how severe were they? If it was a bear market, how big was the loss? And if it was a bull market, how impressive was the gain? And what you can see is when you compare these two, even though there were 11 of these periods where the market dropped more than 20%, the bull markets far outpace and are so much grander than the bear markets that exist in our economic cycle.
Yeah, this is what shows. Whenever I look at this bear markets versus the bull markets, it shows why it's good to be an investor, because visually there is so much more money made than what is lost in those short downturns. Pretty amazing stuff if you just look at this visual. I appreciate First Trust is always so consistent with updating this and providing a really good illustration on why you should stay on path, not get into the timing.
And so then we think about, okay, well, I get that, guys. I get that the market's good, but right now the market feels pretty bad. Right now, the market is in bear market territory. How should I think about this? Well, none of us know when the end of the bear market is going to happen and when the start of the bull market is going to begin. But here's what we do know. If we look at all of these bear markets since 1950, on average, the average loss has been about 35%, and the average duration of the bear market has been 14 months. I would not get caught on that because we don't know where it's actually going to happen. This is what I think is interesting. When you think about the recovery and how markets behave, in the first month after the bottom of a bear market, on average, the market has made back almost 15%. In the first year, the market makes back over 43%. And in the first 2 years after the bear market, the market makes back almost 63% on average.
I think it's interesting. When I look at this slide, I always think, man, there's some traps, some logic traps that people will fall into. They know here we are in 2022, and it's October. We know that this bear market, where the market's down right now, 25% from where we started the year, we're about 10 months into this. Well, a logic trap would be you look at this and be like, well, this is easy. I'm just going to sit on the sidelines for the next three and a half months.
Yep.
And then, or pay attention, we're already down 25%. Maybe I'll just wait for us to be down 35%, and that's when I'll jump in. Here's the reality of the situation. And Bo kind of gave the answer first, but I still want to kind of walk you through falling into these logic traps. We don't really know how long this bear market will last. And yes, we're only down 25% right now compared to the average of 35%. But these things typically, the momentum that builds into that 10% could happen in a week. It could happen in 2 weeks. It could happen just in a matter of days, because it's not uncommon that when you hit capitulation, it's going to pile on very quickly. But then guess what? It happens. That recovery, just as Bo shared, is so quick. So if you tried to wait until we could get to 13 months or we got to 35%, whatever your trigger point is, you're going to miss it. Because as you can see, the first month after we hit the dead bottom, close to 15%. But Bo, you've made this point before. Then the next 3 months is 21%. Isn't it amazing that 2/3 of that 3-month performance was made in the first month?
Very first month.
And then you extrapolate that out 12 months. The average rate of return of recovery is about 44%. But a lot of that, close to half of that, is loaded up in the first 3 months.
That's exactly right.
And then you can see how this builds. It turns very quickly. Be very careful about trying to time the market.
And you might be saying, okay, guys, I get that. But does this really matter? How big of a deal is this? Well, we want to show it to you a slightly different way. Let's say that you look at the time period from 1980 all the way through 2021. So over 40 years of market performance. And let's say if you started with $10,000 invested in 1980, what would that turn into? Well, if you just left it invested over that 40-year period, that $10,000 could turn into over $1 million.
That's amazing.
Almost $1.1 million. If all you did is you got cute and you just missed the 5 best trading days, out of all 41 years, you only missed 5 days of activity, your total portfolio drops down to only $676,000. If you were to miss the 10 best days, it drops to $487,000. If you were to miss the 30 best days, so that's really just 1 month out of a 41-year period, your $10,000 only turns into $176,000. If you were to miss the 50 best days in that 41-year period, your $10,000 only turns into about $78,000. When it turns, it tends to turn aggressively. And the only way you get to take advantage of that is if you are actually in the market when it happens.
I find it interesting because I've seen trolls in the past when they see this stat and this chart come up, they say, yeah, but if you did it the other saying, you instead of missing the best days, what if you could avoid the worst days? But unless you got that sports almanac
That's
from
right.
Biff,
Unless Biff showed up for you.
it doesn't work that way. You can't time. Nobody has the understanding of when bad things are going to happen. But what you can control is, hey, look, we're in an ever-changing economy where it's growing through innovation. It's just human nature. We want to make things better. We want to innovate. We want to grow. The economy overall is an expansion over the long term. You can control staying the course and staying invested all days. Remember to always be buying.
Okay, so what can we conclude from this? What are some of the takeaways? We think there's 4 that are pretty high level when we look at these illustrations. Number 1, the market is unpredictable in the short term. So if you're trying to figure out what it's going to do in the near term, it's a futile exercise. You're probably not going to have a lot of success in that. Number 2 is that good markets tend to last much longer than bad markets. So don't let the fear of the bad keep you from experiencing the excitement and the goodness of the good. The third thing is that when the market changes direction, it tends to do so quickly and without warning. If we all knew when the market would turn, we'd all be incredibly rich. Unfortunately, we don't know that. And then fourth, trying to time the market can be extremely costly over time. If you just miss the quick turn, the rapid V-shaped recovery, it may be very hard to overcome missing that time in the market.
This is the money guy difference. I think most content creators would create this slide, give you these 4 known quantities of investing, but not give you the details.
That's right.
We actually, every one of the 4 charts that we just covered explain the why and the nuts and bolts of why this is going on. And what I love is like there's even unsaid things that you just need to understand about investing and staying the course. Number 1, the market's unpredictable in the short term. As we showed you, long term, you really can start setting and making assumptions because it gets much more consistent if you can just stay the course and not get sidetracked by your emotions. Good markets tend to last much longer than bad markets. Once again, telling you stay the course. Don't let yourself get sidetracked with this. And then remember, when they change, when we have V-shaped recoveries, yes, markets can be down for extended periods of time. And we can see even there's some false recoveries. But the reality is when it truly hits the bottom, that recovery is going to have a lot of momentum.